Good afternoon, everybody. This is Chuck Hughes. Today, we're going to talk about spread trading. And in general, the last several years, the markets really have not been trending very well, and certainly not like they did back in the 1980s or 1990s when you had a clear-cut bull market with the market just trending for years on end. In either direction, but the last 3 or 4 years, very little trend in the market. We could go a whole year with a lot of volatile price movement, and the price of the S&P, for example, it doesn't change. So it becomes difficult if you're a directional trader and you buy a stock or you buy an option in this kind of a market. It's been just, in general, very difficult to profit the last several years. So we've been doing a lot of spread trading, and that's been working out real well for us. So we're going to first talk about married puts, and that's a spread that's created by purchasing 100 shares of stock and purchasing a put option. And this spread can be initiated simultaneously. In other words, you buy the stock and you buy the put option at the same time, or you can leg into a married put spread at a later date. Let's say you have a profit in your stock and you want to protect that profit, you could buy a put option at a later date. So in my advisory service, we do it both ways. We sometimes we'll do a simultaneous purchase of the stock and a purchase of the put option, and sometimes we'll leg into a married put when we have a profit in a stock to protect that profit. And when you initiate a married put spread, the put option limits your risk, and the put option acts as a floor for the value of the stock, and the value of the stock will not go below the strike of the put option. So if you buy a $50 stock, let's say, and you buy the 50 strike put, the value of your stock's not going to go below 50, while that put option is still in force, and it'll be protected until that put option expires. And one of the other characteristics of married puts is your profit is not limited or capped. So if you buy a $50 stock and you buy the 50 strike put, if that stock keeps moving up in price, say to $60, $70, $80, your profit's not limited. And as long as that stock continues to move up in price, then your profits keep increasing. So the profit potential is not limited with a married put. And I want to show you some examples of some married put trades I took recently, and just try to explain how this spread strategy works. My brokerage confirmation here shows that I bought 1,500 shares of American Capital, symbol AGNC, stock at $27.65. So bought 1,500 shares, $27.65. Now, I owned this for several months, and I received $3.90 in dividends. So it reduced my cost from $27.65 to $23.75. So now my cost basis for the stock is $23.75. And the market was starting to go into a correction mode, and the volatility started to increase. So I wanted to protect the profits I had in my American Capital stock. So I bought 10 of the American Capital. These were lease options. Bought 10 31 strike puts at 195. So once I purchase this 31 strike put, then the value of my American Capital stock cannot go below 31. And as long as, until option expiration, when that option expires. And at the time, this is a lease option, so I had probably six or 7 months of protection by purchasing this put option. So again, my cost basis for the stock was $23.75. The stock started to move up in price. I had a profit, so I wanted to protect that profit as the market was going into a correction mode and volatility was increasing. So once I purchased this 31 strike put, the value of that stock can't go below 31. And what I did was I input these the stock price and the option price into the married put calculator, and that will calculate the profit loss potential for this trade, assuming various price changes in American Capital stock. And in this example, from a 50% increase in the price of the stock to $35.63 to an 80% decline in the stock to $4.75. So what this married put calculator does is it will calculate your estimated return based on the price of American Capital stock at option expiration. And if American Capital stock declined 80%, very unlikely for a stock that's paying a 14.5% dividend. Very unlikely, but if it ever did drop 80%, I'm guaranteed to have a 30.4% return. And if the stock goes up 50%, I would still have a 48% return for this trade. So this is a good way to protect your profits during volatile markets and price corrections, both for individual stock or for the market itself. So by purchasing the put option, I'd realize a 30.4% profit regardless of the price movement of American Capital stock. And as I mentioned earlier, you saw in my brokerage statement the cost of the put premium for that lease option put was $195, and I'm going to collect $250 in dividends if American Capital maintains its dividend, its regular quarterly dividend. I'm going to collect $250 in dividends, which actually pays for the full cost of that put protection. So the profits, again, are not capped. So when I did this snapshot, American Capital was trading at $35.45. So I had a 47.6% return. And again, my profit was not capped by purchasing this put option.
Real quick, Chuck, I don't want to interrupt you, but we are getting some questions. For those of you that want to know Chuck's stock selection process, it's going to be very difficult for him to cover that in an hour seminar today. But if you go to mytrademonster.com, click on the month on the webinar archives on September 11th, Chuck actually did a 2-part series which could show you up to how he got to this point of selecting A, G, and C. So I apologize, Chuck. I just want to let people reference that.
Yes, yeah, that's a good point. We do have a trade selection process for the stocks and options that we invest in, and I don't have enough time today to go into that, but as Tom mentioned, we go through that in previous webinars that I've done, the trade selection process, if you're interested in learning how we pick these stocks for the spread trading. Let's look at another married put trade I did. This was for Apple, and my brokerage account confirmations show that I bought 200 shares of Apple, and the average cost was $339.05. So this was last year, and I usually, which brings up another point, when I establishing a stock position or an option position, I try to leg into that position so that the timing can't affect me as much as just taking all of your trades at one time, or creating a position all at one time. So if you're able, if you can do that in 2 or 3 or even 4 increments, that reduces the timing risk of when you enter your trade. So in this case, I bought 200 shares of Apple, average cost $339.05, and Apple stock moved up in price since I purchased those shares at $339. But in May, the stock market entered a correction, and the price volatility started to increase. As a matter of fact, the VIX index went from 15 in March to 2620 in May. So there was about a 74% increase in the VIX index, which measures volatility at this time frame. So I wanted to protect those profits I had in Apple, so I went ahead and purchased 2 of the Apple September 560 strike put options at $43.50. So by purchasing these put options, I purchased the stock at $339, but the value of my stock can't go below $560. So by purchasing the puts, this puts a floor in the value of my stock. Value of the stock, even though I purchased it for $339, can't go below $560 by purchasing these puts. And today was a good example of how this put protection can really help you. With the Google earnings today, with Google down 68 points, if you own Google stock and you had a put option, then if you had the 740 or 750 strike put option, the value of your Google stock wouldn't go below that strike price. So if you had the 750 put option for Google today, even though the stock dropped 68 points, the value of your stock would not go below 750 while that option was still in force. So today was a good example of when you want to have that kind of protection. So by purchasing the Apple 560 strike put at $43.50, that allowed me to lock in a profit for my 200 shares of Apple of $39,490, regardless of how much Apple stock declined in price. And again, my profits were not capped. So even in the unlikely event Apple was to drop 100%, I'd still have a 46% return for this trade. And if Apple goes up 80% to 610, which it actually did, then my return would be 59.5%. So again, my profit potential is not capped, but my risk is, and in this example, the value of my Apple stock, even though I purchased it for $339, can't go below $560. So locking in a 46% return for this married put trade, regardless of the price movement of Apple stock, demonstrates how the low-risk nature of this married put strategy. So this strategy can produce profits even if you have severe price corrections or wild price swings. So when I have this put protection in force, I don't have to worry about disappointing earnings. I don't have to worry about flash crashes or events overseas because I have this put protection in place. So a very low-risk way to invest. And the other thing is I don't have to put in a protective stop for my Apple stock when I purchase this put, because the value of the stock can't drop below 560. So if Apple declines 20% or 40% in price, I don't have to worry about exiting with a protective stop because I already have this put option protection in place. And after I purchased the put options, Apple stock did bottom out eventually, and then it resumed its upward price trend. And when I made this slide, it was trading at 668. So with Apple trading at 668, I had a $57,000 profit and a 75% return for this married put trade. So again, if Apple stock increases in price 80%, I could have a 59% return. If the stock remains flat, I'd have a 46% return with this put protection. And even if the stock drops 80 or 100%, I'd still lock in that 46% return.
Chuck, I'm sorry to interrupt you. With these particular married put strategies, do you ever find yourself exercising the puts if they work against you and you lock in profits, or do you tend to roll them over, or how do you get out of the put side?
Yeah, that's a good question. Most of the puts that I buy for protection expire worthless, but sometimes you will get a stock that just declines in price and stays down. In that case, the put will have some value. So I normally would just exit the stock and exit the put if the stock no longer meets our trade selection criteria. So based on our trade selection at option expiration, if it meets our trade selection criteria, then I'll roll that over, and usually at a higher strike price. And if it doesn't meet our trade selection criteria, then I'll simply exit the position, exit the put, and then exit the stock.
Clear enough.
All right, great. Here's one more example. This is for TJX. I bought 1,000 shares here. This is about a year ago. This was November of 2011. Bought 1,000 shares at TJX, and they had after that they had a 2-for-1 stock split. So I now own 2,000 shares at TJX at an average price of $30.48, and that was split adjusted. So I got 200,000 or have 2,000 shares at $30.48, and again, I wanted to purchase protection to lock in my profits because TJX was moving up in price. So I bought the 40 strike puts at $249, and again, this enabled me to lock in a $14,000 profit for the 2,000 shares of TJX. Here's a married put calculator analysis for this trade, and the minimum return would be 21%, and again, my profits weren't capped. And when I made this slide, TJX was trading at $44.48, so I had a $23,000 profit with this trade and a 35% return. And I've been doing these married puts for a while now. So what I did is I looked at some of my older brokerage statements, brokerage confirmations, and just kind of took a look at some trades I took years ago. And the strategy was working well back then too. And this brokerage confirmation shows 5 different married put trades that I did on this day. Now, this was a simultaneous purchase of the stock and the purchase of the put option. And what I did is we'll just focus in on one of these trades. This is for Royal Dutch Petroleum. I bought 100 shares of the stock at $60.12. $60.12, and then I bought a Leaps put option for $5.50, and this had about 22 months of protection. So for the next 22 months, I purchased the stock at $60.12, and for the next 22 months, the value of this stock can't go below 60. So fairly low risk trade over the 22 month period that this put option was in effect. And the married put calculator for this trade shows that the most I could lose on this trade would be $90 or 1.4%. So over that 22 month period, maximum risk was $90 or 1.4%. So again, this is a really low risk way to invest. And in this particular trade, I was going to receive, over that 22 month period, I was going to receive $473 in dividends, and the put premium was $5.50. So it covered most of the cost of the put. In other words, the put was $5.50, and I was collecting $4.73 in dividends. So it paid for almost all the cost of the put option. And again, I have 22 months for this stock to increase in price, and there's no cap on my profit potential, and yet my maximum risk was 1.4%. Here's another example from that time frame on that previous brokerage confirmation I showed you. This was for Bristol Myers, and with this trade, the maximum risk was $108 or 3.9%. Duke Energy maximum risk was $133 or 4.3%. And what I did is I calculated the average maximum risk for these 5 trades, and the maximum risk for these 5 trades was 3.9%. And if you calculated that out on an annual basis, my annual risk was only 2.1%. So this 3.9% risk on these trades, that assumes that all 5 trades incur a loss, which is unlikely with such high quality dividend paying stocks. So this 3.9% assumes all 5 of them were losers. It would only take one profitable trade with 20% return for this whole portfolio to break even. So even if 4 of the 5 suffered a big loss and one trade had a 20% return, I would break even on this portfolio. And again, my profit potential is not limited on these. So if they go up in price, then profit potential is not limited.
Chuck, is this something that you could see people utilizing in IRAs, sheltered accounts, things of that nature?
Yes, yeah, that's a good question. If you invest in your IRA, or if you have a trust account or a retirement account, most brokerage houses will allow you to buy these protective puts for your stock. So this is really a low risk way to invest your retirement money. And as a matter of fact, these trades were done in my retirement account. So the married put strategy, that adheres to that important concept of limiting your losses and holding on to profitable trades, which are the cornerstone principles of any successful portfolio management. So the married put strategy limits your losses and allows you to hold on to winning trades, and that's really the best way to manage your portfolio over time. And with these dividend-paying stocks, the total cost of the 5 put options I purchased in these actual examples was $2,050, and the total dividends I received was $1,528. So the dividends covered about 75% of the cost of these put options. So very low risk way to invest. So again, just to recap with the married put strategy, your risk is strictly limited. It allows you to maintain your position during volatile price swings and avoid being stopped out. And today, if you owned Google or if you owned Chipotle, you'd be glad to have put option protection enforced today. So today was a good example where the put option protection can really save you from large losses based on disappointing earnings. So with these married puts, you can profit during down markets. The risk is limited, but the upside potential is not limited. And when you have this put protection in place, you don't have to worry about earnings reports or flash crashes or events going on in Europe with the European debt crisis, because you have protection in place, and it's a very comfortable way to trade, low stress way to invest. You don't have to worry about all these world events and disappointing earnings, because you have protection in place, and the value of your stock is not going to drop below that strike price of the put option. Here's a snapshot of the married put portfolio for my advisory service, and we have a $95,000 open trade profit, average return of 58%. And the way this portfolio is structured, some of these stocks, we had already owned the stock, and then at a later date we purchased the put option. So even if these stocks decline substantially, this portfolio will still have profits regardless of the price movement of the underlying stocks, just because we locked in profits when we purchased these puts for most of these positions. So no matter what happens to the price of these stocks, this portfolio is going to be profitable.